Two people walk into the same bank, same building, same logo on the door, same friendly sign that says Member FDIC. One of them waits in line for 11 minutes, gets a teller who's counting down the seconds until her break, and leaves with a pamphlet. The other is greeted by name before he even reaches the counter, walked into a private room with leather chairs, and offered coffee that isn't from a machine. Same bank. Two completely different universes. Today, I'm going to show you exactly what changes, dollar for dollar, as your net worth climbs from $0 to $25 million. The fees that disappear, the phone numbers that start working, the rules that quietly stop applying to you. This is how banks actually treat you at every level of wealth. Let's start at the bottom, because this is where most banks make the most money off of you. If you have little to no money in your account, you are, in banking terms, a liability customer. Not because you owe anything, but because you cost more to service than you generate in revenue. Here's what that looks like in practice. You're more likely to get hit with monthly maintenance fees if your balance dips below a minimum, overdraft fees, historically around $35 per transaction, ATM fees if you use a machine outside your network. Banks aren't hiding this. Overdraft and fee income has been a multi-billion-dollar line item for the industry for decades. It's not personal, it's just math. A customer with a low or negative balance is, statistically, more likely to trigger fees, and fees are profit. Customer service at this tier is usually a call center, a queue number, and a script. You're not being mistreated on purpose. You're simply not profitable enough to justify a human relationship. Now you've got a cushion, a few $1,000s sitting in checking and savings. At this level, most fees start to soften. Many basic accounts waive their monthly fee once you hit a minimum daily balance, often somewhere in the $1 to few $1,000s range, depending on the bank. Overdraft fees don't disappear, but you're less likely to trigger them because there's a buffer. This is also where you start getting marketing attention. Not personal attention, marketing. You'll start seeing offers for credit cards, personal loans, maybe a CD with a slightly better rate. The bank has identified you as someone worth nudging toward more products, because more products mean more fee opportunities and more data on your spending. You're still using the same app, the same branch, the same 1-800 number as the person with $50 in their account. Nothing structurally has changed yet. You've just stopped being a cost center. This is where things genuinely start to shift. Somewhere in this range, many banks quietly reclassify you. You might start seeing the word preferred attached to your account. Preferred checking, preferred rewards, preferred rates. It sounds like flattery. It's actually a tier system. At many major banks, relationship tiers kick in around a combined balance of $20,000 to $50,000 across your checking, savings, and investment accounts. Cross that threshold and you can unlock things like fee waivers across the board, no more monthly maintenance charges, better interest rates on savings and CDs, discounts on loan origination fees, bonus rewards rates on linked credit cards. You still don't have a personal banker calling you, but you've entered a system where the bank is tracking your total relationship value, not just your checking account balance, and rewarding you for consolidating your financial life under one roof. This is also the point where a financial advisor might start reaching out, especially if a chunk of that money is sitting in a low-yield savings account. Not because they're worried about you, because idle cash is an opportunity for them to sell you a managed account. 6 figures. Now you're a different kind of customer entirely. This is roughly the threshold where private banking or wealth management divisions start to notice you. At many institutions, dedicated relationship managers become available somewhere between $100,000 and $250,000 in investable assets. Though the exact cutoff varies bank to bank, what actually changes? You get a name, not a queue number. A dedicated banker or relationship manager who knows your account history without you repeating it every call. Custom pricing appears. Loan rates, mortgage terms, and credit card perks start being negotiable rather than fixed. A relationship manager has discretion to waive fees or sweeten a rate to keep your business. You get invited to things, seminars on estate planning, market outlook dinners, client appreciation events. These aren't purely generous, they're retention tools. Acquiring a new wealth client is expensive, keeping an existing one is cheap. Products get more sophisticated. You start hearing about managed investment portfolios, structured CDs, and tax advantage strategies that were never mentioned when you had $5,000 in checking. The psychological shift is real too. At this level, the bank starts treating retention as a priority. They know you're big enough to be worth keeping, and big enough to be poached by a competitor. Welcome to private banking, properly capitalized. Cross the $1 million mark in investable assets, and you typically graduate out of the retail banking system entirely. You're no longer preferred. You're a private client. Here's the tangible difference. A dedicated team, not just a person. Often a private banker, an investment advisor, and sometimes a dedicated concierge line that skips the general call center entirely. Direct phone and email access. Many private banking divisions guarantee response times measured in hours, not days. Some give clients a direct cell number. Custom lending. This is huge. At this tier, banks will often lend against your investment portfolio itself, called securities-based lending, letting you borrow against stocks and bonds without selling them, often at rates lower than a standard personal loan. Fee negotiation becomes the norm, not the exception. Advisory fees, which might be a fixed percentage for a retail client, become negotiable based on your total relationship size. Access to alternative investments. Private equity funds, hedge funds, and other vehicles that are legally restricted to accredited investors, a status largely defined by net worth and income thresholds under U.S. securities law. There's also something less visible: discretion. At this level, banks are far more careful about how they communicate, how they document interactions, and how quickly problems get escalated internally. A $1 million-plus client complaining to a branch manager gets a very different response than someone with an overdraft fee. At the top of our scale, you're no longer really a banking customer in the traditional sense. You're a private wealth relationship, and at the upper end of this range, some clients start operating closer to a family office model, whether through the bank itself or an external firm. What's different here isn't just more perks, it's a different operating structure entirely. Your banker works for you, functionally. Private bankers at this tier often manage a small number of ultra-high net worth relationships, sometimes just a couple dozen, meaning far more attention per client than a retail relationship manager juggling hundreds. Bespoke everything: loan structures, trust services, philanthropic planning, multi-generational wealth transfer strategy, art and property financing, all customized rather than pulled from a standard product menu. Access to the bank's own investment infrastructure, co-investment opportunities alongside the bank's institutional clients, early access to IPO allocations in some cases, and direct lines to research analysts. White glove problem resolution. Issues get resolved at a level far above the branch, often directly through senior private banking executives. Total discretion and privacy. At this level, banks build entire compliance and service structures around confidentiality, given the reputational and security sensitivities of extremely high net worth clients. The irony is this: the more money you have, the less banking it actually feels like. It becomes advisory, relational, almost invisible, until you need something, and then doors open that don't exist for anyone else. So what's actually going on here? Banks aren't charities, and they're not villains either. They're businesses that allocate their best resources, their best people, their best rates, their best flexibility toward the relationships that generate the most value and carry the most retention risk. At $0, you're a cost. At $25 million, you're an asset the bank actively fights to keep. The uncomfortable truth is that the banking system isn't really one system. It's several systems stacked on top of each other, and which one you experience depends entirely on a number: your balance. If there's one takeaway from all of this, it's that most of these tiers aren't secret. Fee waivers, relationship banking thresholds, private banking minimums. A lot of it is public information that most people simply never ask about. So the real question isn't just, how much money do I have? It's, am I actually getting the tier of treatment my balance qualifies me for? If you found this breakdown useful, subscribe for more videos that pull back the curtain on how money actually works behind the scenes. Not the version they put in the brochure, but the version in the fine print. I'll see you in the next one.